Have you ever had one of those moments, where a seemingly small issue, maybe at work, maybe even a personal project, just balloons into something huge?
Oh yeah, catches everyone completely off guard.
Exactly. It feels like you had a handle on things, but then boom, there's this hidden risk you just didn't see coming. Understanding those moments, those potential pitfalls hiding in every decision, every activity, well, that's what we're tackling today. Welcome to the Deep Dive. Our mission today is really to give you a solid framework for navigating the, let's face it, often murky waters of business risk. We're going to unpack two, I think, absolutely fundamental concepts, inherent risk and residual risk. And then we'll give you a practical breakdown looking at how different types of risks can actually hit a business based on their consequences. We've basically drawn on insights from a really clear, structured lecture on risk management. Think of it as a kind of fast track to being well-informed, maybe more importantly, proactive about spotting potential trouble. Right, let's jump straight in. Bedrock stuff, I think. The basic difference between inherent and residual risk. This isn't just theory. It's like your early warning system.
Absolutely. So when we talk about inherent risk, you should think of it as the raw risk. It's the natural level of risk that just exists in an activity or a process before you put any controls, any safeguards, any mitigation in place. It's just baked in.
Baked in, okay, like part of the deal from the start.
Exactly. So for instance, a bank lending money to small and medium-sized enterprises, SMEs, right? That activity inherently carries a default risk. That risk is there even before the bank does a credit check or looks at financials. In banking, specifically within something called ICAP, that's the Internal Capital Adequacy Assessment process.
Right, how banks figure out how much capital they need.
Precisely. In ICAP, this inherent risk is the crucial starting point. It's used to design stress models for credit risk, market risk, operational risk. It's your baseline exposure.
Okay, so inherent risk is the raw, untouched danger, the default setting. What happens after we actually try to manage it? Because, isn't that the whole point? Trying to reduce that initial risk?
That's exactly where residual risk comes in. It's the risk that, well, remains after you've applied all your controls, all your mitigations, diligently. It's the leftover stuff, the bit that, might still keep you up at night despite your best efforts.
Ah, okay. So even with protection, something can still go wrong.
Yeah, a really relatable example is cyber attacks. Companies spend fortunes on great antivirus software, firewalls, security protocols.
Which are all the defenses?
Right. But attacks still happen. That lingering possibility, even with strong defense, that's your residual risk. And experts, people working in this field, they're quick to point out that even the best, most sophisticated models will leave some residual risks behind. It's almost inevitable.
So you can't eliminate it completely.
Pretty much. For those ICAP teams we mentioned, it's absolutely critical they don't just stop at controls. They have to actively identify, properly explain, and specifically set aside capital for these remaining post-mitigation risks. The flow is actually quite simple but powerful. You start with your inherent risk.
The raw stuff.
You apply control.
Manage it.
And what's left is your residual risk. And at that point, you have choices. Accept it, transfer it, maybe through insurance, or just retain it and manage it.
And, for you listening, getting this difference is huge. It's not just about seeing the obvious danger up front. It's about understanding those hidden vulnerabilities that stick around even after you've put up your safety nets. It helps you set, I think, more realistic expectations and focus your efforts, your resources on the risks that really remain, not just the ones everyone sees first. It's where real proactive management starts. Now, once you get that idea raw versus remaining risk, the next step is figuring out where these risks actually land in a business. Because let's be honest, a risk that hits your long-term strategy feels very different from one that just messes up your Tuesday operations.
Yeah,
right?
exactly.
So here's where it gets really interesting. Looking at risk, not just by where it starts, but by its consequences. Where does it actually hit you?
Precisely. And classifying it this way helps us pinpoint the specific impact. Let's walk through them. First up, strategic risk. This is the big one. It affects the company's long-term goals, its direction, maybe even its survival.
Like existential stuff?
Yeah, pretty much.
Yeah.
Think about Kodak. They famously failed to adapt to digital photography. That was a massive strategic misstep.
Yeah.
Led to their downfall, really. Or think about the impact of major economic sanctions or big shifts in regulation. In banking, an extreme example would be losing your banking license. That's catastrophic strategic risk. It hits the company's entire viability.
Wow. Okay.
So in banking stress testing, you absolutely have to evaluate how these long-term disruptions, think climate change, new tech, geopolitical shocks, could impact your strategic goals. Okay, next, operational risk. This hits your day-to-day stuff, your processes, your people, your systems, or it can come from outside events. The Basel definition, which is widely used, sums it up well. Risk of loss resulting from inadequate or failed internal processes, people, and systems, or from external events.
Right. So basically anything that messes up the day-to-day running of things.
You got it. We've seen some tragic examples like the Boeing 737 MAX crashes. Those stemmed from system and software design flaws, operational failures at a deep level.
Hmm.
Or remember TSB, the UK bank. They had that huge IT migration failure. Locked people out of their accounts for
Oh,
days.
I remember that. Nightmare.
Total operational breakdown. And in banking, operational risk is a key part of calculating risk-weighted assets, RWA. That directly affects how much capital a bank needs to hold. Then there's financial risk. This one directly impacts your money. Cash flows, capital, investments.
The bottom line stuff.
Pretty much. It's a broad category, includes things like liquidity risk, which is basically can you pay your bills when they're due. Also forex risk, interest rate risk, funding risk, capital adequacy risk.
Lots of ways money can go wrong.
Exactly. A really vivid example was Yes Bank in India back in 2020. They had a serious capital crunch, and it triggered panic withdrawals because people just lost confidence in their financial stability. Moving on, compliance risk. It was about breaking the rules, violating laws, regulations, even internal policies, and the consequences, often hefty fines or serious damage to your reputation.
Right, like the Wells Fargo fake account scandal.
Classic example, huge compliance failure, setting up millions of accounts without permission, ended up costing them $3 billion in settlements. In banking, this risk is closely tied to internal controls, audit findings, and what regulators expect under frameworks like SOX.
Sarbanes-Oxley for corporate accountability.
Right, and COSO for internal controls,
Yes,
and
yeah.
the ECB SREP guidelines in Europe.
Okay, so if compliance is about staying within the lines, then reputation risk feels like what happens when you totally color outside them, right? Or even if people just think you did.
That's a great way to put it. Reputation risk hits your brand image. Stakeholder trust. Hard. Think about the Facebook Cambridge Analytica data breach. That seriously hurt public trust in how Facebook handled personal data. And while you can't easily put a number on it for RWA like operational risk.
No direct calculation.
Right.
Yeah.
But the impact on how the market sees you, on customer loyalty, on your credit rating,
Right.
it can be absolutely devastating. A good reputation takes ages to build.
And seconds to destroy.
Exactly. Then we also think about customer risk. This affects customer satisfaction, loyalty.
Like people just leaving, churn.
Yep, customer churn is the main manifestation. People just take their business elsewhere. Simple as that, but very damaging. Technology risk is all about IT infrastructure, our dependence on cyber systems. An example could be, say, losing money from a hacking incident, even if you thought you had strong password policies.
Right, the residual risk again.
Exactly. Or think back to TSB, that IT migration failure wasn't just operational. Its root cause was technology. Shows how these categories overlap, feed into each other.
Makes sense. They're not always neat boxes.
Definitely not. Then there's people, or HR risk.
Yeah.
This is about your staff skills, people leaving, planning for who takes over key roles. Imagine a key trader suddenly quits at a big bank like Deutsche Bank. That could seriously disrupt operations. Or a key C-suite executive resigns unexpectedly.
Yeah, losing key people or knowledge hurts.
Big time. Location or geo-risk is about exposure tied to where you are, physically or politically. Amazon deciding to pull out of certain states because they didn't like the warehouse labor laws, that's location risk impacting a strategic decision.
Okay, so the where matters.
Absolutely. Knowledge or IP risk. This is about leakage or misuse of confidential data, intellectual property. You see TikTok constantly under scrutiny in the U.S. over data governance, right? Concerns about data getting into the wrong hands. That's knowledge and IP risk in the headline.
Very current, yeah.
And finally, fraud and audit risk. This covers manipulation, deception, and failures in the audit process itself. Think Enron-style accounting frauds. Those directly led to the SOX Act. Or maybe an audit gives incorrect assurance, leading management to make bad decisions based on faulty information.
So internal dishonesty or just getting the checking wrong?
Exactly. In finance, these often get tracked through things like EUC registries, it's end-user computing, like complex spreadsheets that can be points of failure.
Ah, the dreaded complex spreadsheet.
Precisely. Also tracked through internal audit reviews and specialized fraud detection systems.
Okay, that's a lot of different ways things can go sideways. So what does this all mean for you, the listener, beyond just having a long list of potential problems? How does it all connect?
Well, it means understanding these risks don't exist in isolation. They often form a kind of hierarchy, maybe a cascading effect. You could almost picture a pyramid. At the very top, you've got strategic risk, the broadest, most fundamental threat affecting everything below it.
Okay, the peak.
Cascading down from that, you find operational risk, hitting those day-to-day functions. Below that, often intertwined, are financial and compliance risks. And then at the base, kind of supporting everything, you have customer, people, location, and technology risks.
So failures at the bottom can ripple upwards.
Absolutely. Visualizing it like that helps you see how they connect. A tech failure down at the base can cause operational disruptions, which hit your finances, maybe damages compliance and annoys customers. It's all interconnected.
A web, really.
A dynamic web, exactly. And a really crucial point, especially thinking back to banking and ICAP. It isn't just about managing the obvious visible risks. ICAP must specifically identify, measure, and plan capital for those often harder to see residual risks, especially under tough scenarios. It underlines just how proactive and comprehensive, effective risk governance needs to be. You have to look beyond the surface.
Wow. Okay, what a journey we've taken. From really getting the difference between that raw, inherent risk and what's left over, the residual stuff, to breaking down all the different ways risk can actually impact a business based on consequences. We covered a lot of ground. The key thing for you, listening, is that you now have a framework, a way to better understand, maybe even anticipate, the huge range of risks out there. Whether you're dealing with a big corporation, running a small business, or even just managing personal projects, it helps shift your thinking, I believe, from just reacting when things go wrong to proactively spotting what could go wrong and where it might hurt the most.
And while we've talked a lot about what risks are and where they hit, maybe the truly challenging part, it isn't just spotting the obvious ones. It's anticipating those subtle, hidden residual risks, the ones that linger even after we've done our best. What happens when the controls we rely on fail in a way we didn't expect? Or when connections between risks we thought were separate suddenly create brand new vulnerabilities we hadn't even imagined? That's the real frontier of risk management, I think. Thinking about those unknown unknowns.
Absolutely. A really powerful thought to leave us with. And it sets us up perfectly because next time we'll dive into mitigation strategies, how we actually try to manage these risks once we've identified them. Thank you so much for joining us on this deep dive into understanding business risk.